plan. For further information, visit chamberpension.ky.
The Cayman Islands Chamber of Commerce Pension Plan is kicking off the new year with a new website to better serve our members and a new administrator's agent that will help fulfill our vision for your pension plan. Our website, chamberpension.ky, features improved web services like a real-time chat to help answer your questions quicker and audio tips to help you plan for your retirement savings arrangement. Our new administrator's agent, Saxon Administration Limited, will benefit members through enhanced systems and IT services, allowing for a greater customer service experience. The Cayman Islands Chamber of Commerce Pension Plan. We're here for you. If you would like to join or request further information, visit chamberpension.ky. And for information as it happens, follow us on Facebook, LinkedIn, or Instagram. Email admin@pensions.ky or call 745-7630.
Money Sense, bringing an informed financial perspective to the Cayman community.
A very good morning and warm welcome to Money Sense. I'm Simon Caudry, and I have the pleasure of hosting this morning's show and welcoming Georgie Loxton to the studio. Good morning, Georgie.
Good morning, Simon.
Georgie, as some of you will know, is a periodic contributor to this show. She runs her own investment advisory business called Liberty Wealth and has an academic background that derives itself from psychology. And that's part of today's show, is talking about the psychology of investing, mistakes investors make, and perhaps more importantly, why they make them and how they can hopefully not make them in the future. And I think perhaps a topical way of addressing this is to perhaps just look at what's happened so far this year. We're only, 40-something days into the year. And yet we've had quite a chaotic start to the year where markets in aggregate were down maybe 8-10%, and then there's been a recovery of sorts in February. And it perhaps it shines a light somewhat into what investors have done and conversely what they should have done. So perhaps you might tell us a little bit about your experience with some of your investors, typically how they react to movements like this, and then how you try to persuade them that their initial reaction, to the extent it's wrong, isn't the best thing for them to do.
Such a good question, Simon. And the first thing to say about what's happened so far this year is that it is completely and utterly normal. A 10% correction in the markets happens approximately every single year. In fact, the peak to trough decline in the S&P 500, which is the 500 biggest companies in the US, which is broadly how we define the stock market in the US, within the year, that peak to trough decline on average since 1980 has been 14%. So despite the fact that the market ends up 3 out of 4 years, it falls within the year on average 14%. So we didn't get that far this year so far, that correction. I don't think we even actually hit 10% on the S&P on a closing basis. Anyway, I think it did on an intraday basis. So completely normal what's happened. But, of course, we forget history and we see this fall, and our brains unfortunately react in, as you're alluding to, all the wrong ways, because we're not really very well evolved for financial markets. Our brains evolved on the savannas of Africa 100,000 years ago.
I thought you were going to say we're just not very well evolved for just in financial market terms.
Our brains are not evolved to cope with financial markets, and what happens is the part of your brain that is responsible for survival, for just making sure that you get through the day alive, reacts to what's going on in the financial markets.
So these negative stimuli, these market declines, these panic moments.
Yes, panic moments. And they've actually watched this going on whilst hooking people's brains up to MRI machines in the lab.
It does sound slightly scary when you phrase it like that, hooking someone's brain up.
Yeah. But they've done it, and they've watched the amygdala, which is you've got two almond-shaped structures at the base of your neck, which are called the amygdala, and that's the part of your brain that's responsible for the fight or flight response. So if I suddenly throw a snake into your lap right now, it's your amygdala that's going to respond. And
I would be a professional, carry on calmly and would not panic.
And know that it's a fake snake. Right. So it's the amygdala that reacts in a fight or flight response, and they watch this when people are trading or they're investing their money or even thinking about investing their money. This is the interesting bit. They've watched the amygdala start to flare up. So your brain, when the market falls, which it does every single year, your brain is telling you, you might die, you might die, you might die, make yourself safe. And that make yourself safe comes out as, I'm going to sell before I lose any more, right? It's down 10%. This does not feel good at all. I'm going to get out before I lose any more.
But why can't our brains then rationalize and say, well, this isn't a near-death experience.
Right.
This is, I say simply, I don't want to trivialize it, but this is simply a loss of part of my wealth. That
Temporary.
Temporary. And
Temporary
that doesn't equal death, so I will survive this. Temporary as well. Why is it so difficult for our brains to compartmentalize those two concepts when we know factually those are true statements? It's one thing to be chased by this vicious predator, and it's another to see a number on a screen change by 8, 9, 10%.
I think part of it is that irrational, quick thinking part of your brain takes over. And for people who do stop and think it through, or people who have somebody to think it through with, so, my clients will speak to me and say, this doesn't feel good. What should we do? And I say to them, this is completely normal. I know it feels a little bit scary, but it happens every year. The absolute best thing we can do right now is absolutely nothing. Right? Doing nothing is a decision. It is a choice. And when the markets go down, we want to make sure that we do nothing. We don't react to that volatility, that completely normal volatility. And we reiterate to our brains that we haven't lost anything. As long as we're diversified, we haven't lost anything unless we sell, because the volatility is temporary. What our brain is making us want to do is mistake that temporary volatility for a permanent loss. It's wanting us to mistake. It's probably the most important thing an investor can ever understand. Your brain is making you want to mistake that temporary volatility for a permanent loss. And it's not a permanent loss unless you react and sell. And the reason it's not a permanent loss is because every single time in history that the market has gone down, it has always turned around and come back up again.
Why is it we can't learn that then? In the sense that you might say that to somebody this month, and then in 9 months, 10 months, 12 months' time, the same scenario plays out, and the same person, most probably, will have the same response, come in with you, have the same conversation, you give the same narrative. Humans have typically been quite good at learning. We study, we learn, we improve, but we're not seemingly able to improve or learn this sort of matter.
No, we've got absolutely no better at it over hundreds of years, and that is fascinating because humans, as you say, like we've got better in every endeavour that we do. We're better in medicine than we were 100 years ago, right? You quite happily have an operation today, but you didn't want to 100 years ago.
Well, I would say happily.
Right, but we're better in technology. We're better in so many parts.
Yes.
But when it comes to investing, we are making exactly the same mistakes as Sir Isaac Newton did in the 1700s. Right, the smartest man on the planet did exactly this, panicked out and lost his entire fortune, having got into a bubble right at the top and then panicking out. He did it. So I don't know the answer to that, Simon, but I think we just don't learn lessons very easily. And you can look at that in all parts of history. Why do we go to war? Why do we do these things? It's human nature.
Have your clients then responded to this recent market disturbance in the typical sort of way, or has it been different this time in any sort of way?
I have very well behaved clients, Simon. I do a lot of educating with my clients and a lot of talking about what volatility is and what it isn't and what risk is and what risk isn't. So I haven't had to deal with much in the last 6 weeks in terms of people wanting to panic. But certainly not last year, we're in 2022. 2020, when we had the COVID crash, that was very different because what happened there was we had a fairly normal fall in the markets, but it happened very, very quickly. It was the speed of it that was unusual.
And it also happened for reasons that didn't have a lot of precedent in recent statistical memory. Yes, of course, we had the Great Flu, but markets were very different in that time, as opposed to, yes, an oil crisis or, yes, an inflation crisis. We've had many more of those.
Absolutely. So you combined a fall in the markets with something unprecedented, that felt unprecedented, which was the pandemic. And so what our brains then say is, yes, but this time, the four most dangerous words, this time it's different. And that's what happens when we have a crisis. And of course, this happened as well in the 2007 and 2008 crisis when banks were going bust over the night. And it also happened back in when we had the Twin Towers in the US, and that was very different. Every crisis you can kind of look at and say it's different. And then what we want to do is say, it's different this time. This is absolutely the time that I have to get out the markets because it's going to go down and it's never going to turn around and come back. Like the world is different today than it ever was. And you could rationalize that in your brain in March and April of 2020, right? Like everything is different now. We've got a pandemic, businesses, how are businesses going to survive, blah, blah, blah. And you get out after a 35% fall and you've made the biggest investing mistake of your life. And so that's the danger. And then what I have to say to people is, I know it's different. Every single crisis that has gone before this one has been different. But the thing that's the same with every crisis is that they end. Every single crisis that humans have been through has ended. And when it ends, in fact, long before it ends, the market turns around and comes back up again. And it will. I don't know when it's going to happen, but I know it's going to turn around and come back up. And lo and behold, 6 weeks later, it was shooting back up on the back of, massive stimulus from governments all around the world and, the hope of a vaccine. And here we are today.
It's funny you phrase it like that, because I guess close to the time when things were at their worst in 2020, I remember having a conversation with a friend of mine, an American friend, and one might occasionally make fun of Americans, as I do most other people as well. But it's interesting that psychologically, he's of the sort of school of thought. And he said to me at this time, he said, but Simon, human ingenuity is incredible. We'll get through this. And at that time, I was thinking, but this is pretty bad.
Yeah.
And
how are we going to get through this one?
But I don't know.
But we will.
And he's always very optimistic, and it's a psychological trait that he has. And it's often repeated a little bit in Americans as opposed to English people. There's a more, generally speaking, in my perception, they're a more optimistic group of people than Brits are. But that sort of attitude, you've got to have sort of a good devil on your shoulder and a bad devil, and you've got to listen to both of them. And someone like that is saying, I haven't got the foggiest idea, well, he didn't use these words, but I haven't got the foggiest idea how we're going to get through this or what the solution to this is.
But there will be one.
Yes.
Yes, absolutely. And that is exactly what I said to people back then. And in every crisis that's gone before, human ingenuity is the most powerful force on the planet. And the only way...
But the definition of human ingenuity is we don't know what it's going to do.
Exactly. Yeah. And the only way that you can capture human ingenuity is through owning all the best businesses on the planet, which is what you own when you own the stock market. Right? Those businesses reflect human ingenuity. And I think people forget that. And the point about optimism is so important, because maybe I'm fast forwarding here, but if you get to how you protect yourself from making those big mistakes, being optimistic about the future is so, so important. It's very hard to be a good investor and make good decisions if you're a pessimistic person and you always think the world's going to end. You're always going to be getting out of stocks. You have to look at history and say the world is always getting better for most people most of the time. Capitalism does function in that way. And we have to assume that's going to continue and be optimistic about the future. Yes, it's going to be punctuated along the way with crises and things that go wrong, but we always turn around and come out of it.
There's always somebody being born who is smarter than everyone who's gone before him or her. And there is always somebody who's what kids are learning in school today, I'm fairly sure, not being in school today, I can't guarantee this, but I'm fairly sure is more advanced than what I learned when I was at school, because knowledge has improved, and by definition, therefore, they're starting at a much higher base than we ever could have done. And by definition, therefore, once they get to the stage of being able to invent things, it's the standing on the shoulders of story, isn't it? Absolutely. Yeah. It's if only it were that easy, though. If only it were that easy. And it's not, because, the famous physicist Richard Feynman said the most important rule is that you don't fool yourself, and you are the easiest person to fool. And Daniel Kahneman, the famous behavioral economist, talks about this all the time. He wrote a whole book on this about biases and how we, all the different biases that humans fall prey to. And then he says at the beginning of the book, the fact that I understand all of these biases does not make me immune from making all these mistakes. Awareness is the first thing. Absolutely, you have to be aware of your brain and how it's working and what your brain's trying to make you do. But awareness isn't even enough, unfortunately. I don't want to big up your business too much, but I'm kidding. But it comes to the point, you can read and understand and digest to exactly your point. You can learn everything, but at some point you need somebody independent, impartial, to tell you you're being a damn fool. To tell you, and you must not do this. Right. Yeah. And as painful to hear that sort of thing is, especially in the moment of crisis, a day later or a week later, once you've digested that knowledge and you've reminded yourself that, yes, this is what the evidence suggests, then it's obviously the right decision. But it's very difficult to hear, isn't it?
Mm-hmm. But that is the most important role of an advisor, if you're going to use that term. Somebody who's helping you with your money is to actually just stand between you and that one big mistake. And if you can have somebody standing, or something or somebody standing between you and that big mistake, then that person or that thing can, pay itself in multiples by just helping you avoid that one bad decision.
Exactly. To your point, if something's gone down 30%, it takes some time to recover from that. You're better off not having done anything ever.
And the problem is, if you get out at the bottom, you sit around waiting for a very, very long time to get back in, and often you never get back in.
Because people don't tend to like to buy once something's gone up. With that, we're just going to take a brief break, and we'll come back and rejoin this conversation talking about investor psychology and how we can better learn to do better things and behave in better ways.
As the longest established pensions plan in the Cayman Islands, the Chamber Pension Plan looks forward to delivering the same strong performance for our members, but now in a new location. As of March 1st, our new pensions operation office is located at 14 Saturn Close, Eastern Avenue, the same building as our new administrator's agent, Saxon Administration Limited. A dedicated and experienced team will be assigned to the Chamber Pension Plan. If you would like to join or request further information, visit chamberpension.ky, and for information as it happens, follow us on Facebook, LinkedIn, or Instagram. Email admin@pensions.ky or call 745-7630. The Cayman Islands Chamber of Commerce Pension Plan. New location, new administrator's agent, new customer service, same strong performance.
Money Sense, the only personal finance radio show in the Cayman Islands, hosted by Simon Caudry from the CFA Society Cayman Islands.
This is Money Sense.
Welcome back to Money Sense with our guest Georgie Loxton. Apologies for that. We are talking today about psychology and investor behaviour, and before the break, we were going into the meat of this subject and to what it is within the brain that causes people to behave in what in hindsight look like illogical, well, not look like, which are illogical, but they are based on years or decades or centuries or millennia, I suppose, of human evolution, and that's what's caused it. So let's just I try and identify now a couple of typical mistakes. We talked about the factors that cause people to make these mistakes. So what are specifically some of these mistakes that investors might make? And then we can try and assess how to prevent, or at least how to learn not to do those things.
Well, I think they all come down to this: human nature is a failed investor. Human nature is a failed investor because we constantly misunderstand risk. And that goes back to that mistaking the temporary volatility for a permanent loss. And so what that leads to most often is the panic out at the bottom. And we see this when researchers look at the market and they look at flows in and out of the stock market. The biggest outflows always have occurred right at the bottom of the market in 2009 and 2020 when we had the COVID crash, and likewise the biggest inflows come right at the top. So we know rationally that we want to buy low and sell high, yet we continually do the exact opposite. And part of the buying high bit comes from this concept of FOMO, the fear of missing out, that is very prevalent today, particularly with all sorts of very speculative investments that, you hear your best friend or your neighbour getting rich on something. And it's very hard for us humans to resist that. And that also goes back to evolution, because we're tribal at heart. We are tribal creatures. And when we lived in tribes on the plains of Africa, if you were at the back of the tribe, you were the one getting picked off by the lion. You did not want to be at the back. You wanted to be keeping up. And that lives on in us today, this kind of keeping up with the Joneses mentality, and that when we see people getting rich, we want to have a part of that. And so what tends to happen with that is that we pile all our money into a hot thing right at the top, and just as it crashes. And so that's a very common bias as well.
And another one that's, I think, is manifesting itself in different ways, but it's about the inability to see new facts. There's a phrase for that, isn't there? But you can expand on this a little bit more. But it's the inability to change one's opinion when circumstances or events or facts present themselves in a different, or new facts present themselves, or new information presents itself. One retains the same perception despite the new evidence, possibly because people don't want to look at the new evidence. So explain that one to me.
It's a fascinating one, and that's partly overconfidence. And they think this is because when we form a belief, whether it's a religious belief, whether it's a belief about a vaccine, whether it's effective, which is today's belief, or whether it's a belief about anything, our brain has invested an awful lot of time and energy into coming up with that belief.
And it could be a belief about Microsoft's a good company to invest in.
Totally. But your brain has invested energy in coming up with that belief, and therefore it actually hurts your brain to change that. They've shown it actually that, again, the part of the brain that is responsible for physical pain, when you're presented with data that contradicts the belief that you've come up with, your brain just doesn't want to look at it. It just says no, I know this to be true, and then you seek out confirming data for your belief that you have already formed. Whatever that belief is, the vaccine is not effective or is effective. You can find information on the internet that will corroborate whichever way you believe, right? And so all you do is seek out more confirming evidence, and your brain does not want to look at the other side of the argument. And it is the most important thing we can do as an investor and as a human being, is to look at information that does not confirm the beliefs that we have, to make sure that we are still on the right track with the things that we think are true.
You see, this show is about investing, but I think there's a topical analogy to that, which is, take the example of, for instance, Hong Kong. Right now we're talking what's going on in the world, and clearly somewhere like that have made the policy decision that they're not going to allow COVID to exist. It's just not, they're going to have a zero COVID policy. And yet the evidence is that COVID doesn't kill people, normal people now. It might cause suffering to those who have compromised immune systems, but does not killing people as it was.
Healthy, vaccinated people.
Or not even necessarily vaccinated. It's not actually killing many other people either. And yet policymakers there have found it very difficult to change that approach because, to your point, it hurts them. Maybe it hurts them politically, perhaps, but it also hurts them psychologically as human beings to say, I was wrong. Yeah. And
it's really hard to say that I was wrong.
And so we get, especially for men. I mean, let's not dwell around that one.
And that has been shown, right? The overconfidence bias.
Although
is
interestingly,
a little bit worse
the
in
leader
men.
in Hong Kong is a lady, if I'm not mistaken.
And New Zealand.
Yes, that's right. Yeah. But it becomes what happens then is that policy, whether it be investment policy or whether it be political policy, healthcare policy, gets driven by faulty behaviour of humans, because it's humans that set policy. Policy is not set by a robotic machine. And so we keep policies that no longer make sense longer than would be rational to do so, or it takes too long to put policies into place that would be rational to put into place, in the same way that we do investing. So I say this not as a political statement, but simply to draw the analogy that psychology of investing is exactly the same as psychology of policy decision making. We make the same mistakes in both. And it's very difficult for politicians, as it is for you and I and every listener here, to admit they got it wrong when they didn't invest in Google or Amazon or Apple at the IPO, or when it was $2. Because you say, and I remember actually when Amazon was starting out, I said, who in their right mind wants to buy books online? I mean,
totally.
Yeah. So that's ridiculous. And then Amazon never made any money. It was always making losses, and that just seemed ridiculous. And then seemingly overnight, suddenly it dominated the whole world, and that was the only way you could buy things.
And then it seems so obvious, right? Yes. But in hindsight, and the thing that people forget about this,
hindsight takes a long time to come along.
Out when it does take a very long time.
It's not immediate. That's an important thing. So that's why policy mistakes and investment mistakes take a long time to correct, and that's why people, from my experience, people suffer longer periods of losses or longer periods of missing out than is rational and sensible for them.
Absolutely. And the key thing here, Simon, is that we just have to understand that humans are not rational. We are not. We are completely and utterly irrational. And so much of the stuff.
My
that
whole
we
economics
read.
course is about rational
Yes,
human
I was
beings.
about
They're
to
ruining
say
my mind.
exactly that. Like economics is based on the fact that we are rational and we're not, and that's what I love about kind of.
I've trained myself to be as rational as humanly possible.
Yeah.
As humanly possible.
But the finance world today, you know, the world of behavioural finance has sort of realised this, right?
Yeah.
That humans we clearly do not act rationally at all, and so much. And I think the quicker you realise that as an investor, the better, because you could look at, you know, the market today and say, you know, the US market is overvalued and and on a rational basis we expect returns to be lower. But this could go on for a decade or 2 decades because humans aren't rational, and we're storytellers, and we follow a story. That's what humans want, is a story.
And that's something I remember when I first got into the investment industry. There was this thing called momentum investing, and I couldn't for the life of me figure out why anyone was talking about this, because it wasn't as a economics student coming out of university, it wasn't something that made rational sense.
Absolutely not.
And yet billions and billions and billions of dollars are made in profit as a result of following such trends and following such behaviors. So it would be irrational not to accept that that's what happens. It would be dumb to not accept it. So it's a very strange thing for a human to have to accept that they don't behave in a logical and rational way. Yeah, because that itself seems irrational.
Totally, and I think that is the heart of being a good investor, is acknowledging that and then having humility around it. Because another thing that, I mean, this is the overconfidence bias, is that humans tend to think that they can predict the future, and they can't. And sometimes they get lucky with it, and then that's the most dangerous point, is when they've made a prediction that comes true and they think they're a genius.
Well, the person who called the crash 5 or 10 years ago or 20 years ago is always that person who called the crash.
And when you look back, and then they keep calling the crash over and over and over again. I mean, you know, we've got that today with many commentators. But I think it was Peter Bernstein, the famous writer, who said, the riskiest moment is when you are right. And that's about predicting the future. And we have to, as investors, acknowledge that we have absolutely no idea what's going to happen next, and invest accordingly. And what that means is that we have to build up a margin of safety in our financial life so that we're not over leveraged, and that we've got cash, you know, in the bank, and that we've got a diversified global portfolio. And then we can kind of sit back and say, we don't have to predict the future. It doesn't actually matter what happens next. We ultimately know what's going to happen in the markets, and that is that in 20 years they'll be up.
Or in 20 years the future will be better,
than it
broadly
is today.
speaking, in aggregate, than it is today. And that doesn't mean that your financial circumstances or your neighbours will necessarily be better. And as hard as it is to accept that, that's really irrelevant from an investing perspective. Whether your job is going to be better, your life is going to be better, doesn't matter as long as in aggregate the world is better.
Totally, and the world will be better. Well, if we look at history and we're rational, we try to be rational about and probabilistic about what's happened in the past, and then we will look into the future and say, yes, in 20 years, the stock market is going to be higher. There's never been a 20-year period in the US stock market anyhow where it's been down. Even if you'd started investing, you know, right before the Great Depression, 20 years later, you were still up. So we have to look forward, and we have to have that margin of safety in the way that we invest, but also in our financial life as a whole. And then we can relax and say, we don't have to make any predictions about the future.
Well, let me ask you that. We only have a couple of minutes left, but margin of safety. What is your general advice then to clients when they are saying, well, how much of my wealth, I've got this 100,000, I'm earning whatever it might be, 50,000 a year. What's a sensible amount that you need to keep aside as very liquid, non-volatile money in order just to prepare for those eventualities? What do you tend to say to people?
It's a great question. Any money that you know you're going to need for some kind of capital project, whether that is paying for your daughter's wedding or, putting a down payment on a house.
Fixing your heater or air
anything
conditioning.
that you know you're going to need in 5 years should be in cash.
Yeah.
Right? Anything that for something important, that should not go in the markets. And then I tend to say to people, at least 6 months, ideally, we'd get to the point where we had 6 months of living expenses on the side in
So
cash.
you make the assumption that you won't have a job and that it will take you 6 months to find something.
Exactly
and
that.
then you can still survive without having to panic, without having to dramatically change your living standards or your lifestyle.
3 months at an absolute minimum. And for some people, it's more like a year. Mm-hmm. That does depend on the kind of job that you have, how stable your job is, how lumpy your income is. That, for someone who's, for example, a real estate driven by commission, that would be very different to a lawyer who's paid a regular salary. You know, the lawyer might be happy with 3 months of living expenses, although I would probably still urge them to have 6. But a real estate agent might want closer to a year. But you've got to have that set aside. And then, you know, if you're trying to build wealth, then really most of the rest of your liquid assets ought to be in the stock market, because we know that bonds, unfortunately, do not build wealth. They do buffer you from volatility. And that comes back to this behavioural psychology side of it. But if you can live through that volatility because you have someone helping you get through it.
And you've put this buffer aside.
And you've put the buffer aside. And, you know, you're not over leveraged on your home. You know, you've got a low level of mortgage and all these other bits are in place. I think, personally, and this is my opinion, that people can take a lot more sort of, I quote unquote, risk in their portfolio than they think they can. I.e. they can get the market return. Well,
with that, loud and clear in our ears, thank you for that very helpful guidance. We are regrettably at the end of our show. And so
it's never long enough.
Well, it isn't. And it has been a distinct and immense pleasure having you on the show as always, Georgie. So thank you very much.
Thanks, Simon.
My final note then for all our listeners is to, first of all, thank you for joining us this morning, and to remind you that we are available for questions, for topics that you wish us to cover at MoneySense, at candw.ky, or tweet us at MoneySense Radio. So you can email us, tweet us, or send us a message through the CFA Society Cayman Islands, on whose webpage this show will be shown. This show will be stored as a, what's it called? A podcast. That's the word I'm looking for. So with that rather inelegant ending to this show in my part, thank you very much to our listeners for joining us. Goodbye, and please do tune in to Money Sense in 2 weeks' time.
Money Sense is brought to you by the Chamber Pension Plan. For further information, visit chamberpension.ky.
The Cayman Islands Chamber of Commerce Pension Plan is kicking off the new year with a new website to better serve our members and a new administrator's agent that will help fulfill our vision for your pension plan. Our website, chamberpension.ky, features improved web services like a real-time chat to help answer your questions quicker and audio tips to help you plan for your retirement savings arrangement. Our new administrator's agent, Saxon Administration Limited, will benefit members through enhanced systems and IT services, allowing for a greater customer service experience. The Cayman Islands Chamber of Commerce Pension Plan. We're here for you. If you would like to join or request further information, visit chamberpension.ky. And for information as it happens, follow us on Facebook, LinkedIn, or Instagram. Email admin@pensions.ky or call 745-7630.